The top 5 research strategies when completing due diligence on a property market. Now, this is a really good topic. It's a very tricky one as well because there's so much information I can give you guys. And I want to be precise and give as much value as I can as possible. So, when it comes to looking at a region, I guess, the research is super important. We want to make a calculated decision. We don't want to just invest blindly and just go, you roll the dice. This is something that you want to make an informed decision. It's called calculated risk. We're not risking, we're going to risk all our money and finances and borrow other people's money as well to just make a decision without any research behind us. This is super important. So the first one I've got here, what is driving the market? Now, every market has something that influences it. And there's so many things that will influence that market. Now, number one thing I'll put here is, I guess, it's infrastructure projects, jobs, economic industries, and there's a whole bunch of other things, movement of people, and there's a whole bunch of other categories, GDP rating, and some other economic trading statistics that you need to look out for. But these are some of the main things, and infrastructure projects are super important. Now, Melbourne and Sydney, back in 2000, had a lot of things happening for it. And there was a lot of infrastructure projects, a lot of, extension of rail links, of transportation hubs, of industries coming in there, job creation, and things were starting to change in Melbourne and Sydney. Now, what happened with those markets? Those markets blossomed, and the other, those suburbs started to change as well. Why? Because there was universities getting built, more hospitals getting built, and a whole bunch of other things that were influencing the market. Now, today, that is still happening. But, Melbourne and Sydney really don't have anything driving it anymore because it's already been developed. Now, there's always new things getting implemented, but this is something to look out for. Other states and territories and suburbs that are having this influence. Now, if we look around Melbourne, around Australia, there's a lot of budgets that have been, granted to certain states and territories from the federal government. Now, this is helping them, implement infrastructure projects that are going to influence the market. These things happen. Why? Because there's signs there, there's signs of supply and demand, there's signs of people moving there. And these things they're creating jobs. And when they're creating jobs, people are moving there. That's what we call internal migration, not overseas migration. Then we have industries, I guess, economic drivers. What influence the market? Is it the agricultural sector? Is it the retail sector? Is it the healthcare sector? These things are something that you can get on ABS data and have a look at industries that are driving that market. And we want to see an increase over every year. By doing so, what does that mean? That means that there's something happening there, and not that there's the GDP in that state in that region is improving, but it's having an influence on the Australian economy, and of course all over, especially in that suburb or in that LGA as well. So this is not it's a big jigsaw piece puzzle when we're looking at property. It's not a few bits and pieces. It's a big jigsaw piece. It's very, very sophisticated, if you want to use that word. Now, number 2 is supply versus demand. So microeconomics. So I look at things like this is your vacancy rates, your days on market, stock on market, inventory levels, public housing levels, how many renters versus owner occupiers in a particular region, and then we go to a street level. This can continue. There's so much, things we look out there, and we look at market timing values, we look at supply versus demand values, we look at a whole bunch of other things. Now, neighborhood, region values, and what's the difference. Now, these are so many, micro level economics that we can look at now that you need to make an understanding, a calculated decision, because you don't want to be investing in an area where the vacancy rate is through the roof. And when I mean through the roof, it's high. And when it's high, the vacancy rate is high, the likelihood of you getting a tenant in there can be maybe a month or 2 or 3 difference where, you have to drop your prices because you're struggling to find a tenant. So what happens is the vacancy of your property actually becomes unoccupied for a very long time. And what happens, you start to lose rent. So we want to make sure it's got a competitive vacancy rate. Anything below a 3 is amazing. I like to go anything below a 2 is something that you want to be in the safe. You'll be in the safe haven. Anything above 2, but this is a rule of thumb. I can say that, but anything that's above 2 or 3, in between the 2 or 3 mark, we want to see a decline from the previous years. And when we say a decline or vacancy rates dropping every year, what does that mean? That means there's something happening in the market, because everything doesn't happen straight away. It takes some time. So vacancy rates have to be low. Stock on market, you want to see in a good percentage formula. So I use inventory level, which gives me a good calculated decision. The lower the inventory level, the stock on market level, the lower it is, of course, the less properties on the market. What does that mean? More supply. And then, of course, there's going to be higher demand. Less supply, higher demand. And we don't want to have too less of a supply, because if there is too less of a supply, it's going to be very competitive for you to buy an investment property. You've probably missed the boat. So we want to have it in a good range from, say, anything above 3 to 5 or 6%. In between that, anything that gets past that 3%, you're going to be in dangerous territory. You're going to be in a territory where there's going to probably be 5, 6, 7 offers already on the first open home. And we don't want to be there. We want to be there before the herd gets there. Days on market, that's another thing we want to look at. We want to see days on market, which is saying how long does it take the property to sell for? And it might be 100 days in a particular market, which is a long time for some people, depending if you're in the capital cities. But it might go from 100 and then 6 months down the track, it's gone from 100 to 70 days on days on the market. So then you start to see there's a change and something's happening in the market, and there's a decline, and that gives you a supply versus demand. Next thing is number 3 is ugly duckling syndrome. So when I hear that I wouldn't invest my money in this suburb because it is a gringy suburb. Oh no, there's a lot of, maybe there's some public housing, or maybe the demographic of people, you're not, it's something that people cringe and go, oh, but it's got, it's certain people that live there, and it's not my, it's really rough, and they start saying all these negative things. My eyes light up, because they're the best locations. If we look at some of the best locations in Melbourne, in Sydney, that were those rough economic areas that people go, oh, I wouldn't live there. Places like Maverickville in New South Wales, or maybe if you go to Melbourne, Richmond or Footscray, some of these places people go, oh, I wouldn't live there, or Frankston. But what has happened? There's been a change, a shift. Blacktown in New South Wales is another one. And these places have changed, and now these places are worth millions and millions of dollars, because things start to happen. Gentrification starts to happen. So ugly duckling syndrome, look for those areas. Even the street, when it comes to a street level, or the property in a street, we don't want to purchase the nicest property in the street. We want to purchase that, we want to buy the nicest street, but our property is the ugliest property in the street. Why? That gives you the advantage to do renovations, give you that, that reassurance. Like if you do put money into the property, maybe you spend, depending on your strategy, $20,000, $30,000, $40,000 on your property, and that can give it an extra $100,000, $150,000 or $200,000 of equity uplift. That gives you the opportunity to do that, called forced appreciation. So this is something that's really, really underlooked, and I think it's a really great strategy as well. Next thing, doing due diligence, is your zoning reports. This is super important. People don't do this. They just go buy. They don't know it's in a flood zone. They don't know if it's in bushfire zone. They don't know if it's even in a flight path zone. They don't know the zoning on the property. If they want to do development or something, they don't know if there's an easement on the property or any sewage lines on the property. These are things you need to look out for, because if you're going to do, you got to look. If you're purchasing an investment property at the beginning of your portfolio, and you're new to investing, people go, no, it's all right. I don't plan on developing, or I don't plan on adding a granny flat or subdivision or anything like that. But let's say 10 years goes down the track, and you're someone that's sophisticated, and you're an investor, and you're now 10 years down goes down the track. You've already got a pretty big portfolio, but you say, you know what, I'm sick of buying in property. I want to do a development now. So you decide to do a development, but you bought your first one or your second one without doing the right DD. And what happens is that you find out maybe there's an easement on the property, or maybe it's not the right zoning, or maybe you can't do certain things to it because you haven't done your due diligence. So it's super important that you always want to minimize these things, because that makes your property even more valuable. If it's got less zoning defects on the property, that's going to make your property more valuable. So that's important as well. So don't just say, don't worry, it'll be okay. I don't plan on doing these sort of things, or, I'll take the risk, and it's never flooded here before. Maybe it's in a flood zone, or it's on the outskirts of that flood zone, or not far off. Don't take those risks, because you don't want anything bad to happen to your portfolio. Which leads me to my next one, which is something that definitely gets left out, which is insurance policies. You go into a region, great value for money for properties. And you might say, okay, well, let's go buy this property. You know, it's well priced. I've done all my checks. The infrastructure projects are there. Days on market is dropping. Vacancy rates are dropping. It's the ugliest property in the street. It's one of those locations that, you know, it's got a bit of a bad name to it. I've done my research with the zonings. It's not a flood zone, bushfire zone, etc. Last thing comes down to is, what's the insurance policy like? Now, some places in Australia might have high risk of maybe flood zones, or maybe it might be high risk of cyclones, or maybe because of natural disasters. Now, you go and get a insurance check policy or policy check, and what happens is your insurance policy might be 3 or 4 times higher than the general average. And this has happened before. You don't want to buy a property and then you find out later it's $2,000, $3,000, or $4,000 a year to have insurance on your property because of it's in a high risk area. This is something to look out for. Okay, so these five tips that I've given you is going to help you make a better calculated decision. Now, there's always going to be, we can go on a deeper topic of each individual topic here and really break it down, which is something that we'll leave for another time. But this is something that is crucial and you need to know. Now, if you're watching this and you want to know more about 1, 2, 3, 4, or 5, put a comment in the search bar here and we'll definitely create something here and we can send that out to you as well. So it's helping you make a calculated decision. Remember, you have to take a risk when it comes to property investing, but it has to be calculated. So that's the key to investing. We don't want to be a risky investor. We want to be a calculated property investor.